Hey, this is Chris. Now, these days we have a lot of self-managed super funds, SMSFs, coming to us for advice around their own external portfolios, and we help with a portfolio review. And so in this video, I'm going to be talking about the four main mistakes we see in SMSF portfolios that come to us. So the first mistake that we see over and over again is too much cash and term deposits in their overall SMSF asset mix. Now, term deposits and cash were a fantastic place to hide during the financial crisis. Historically, Australia has had quite high cash interest rates relative to the rest of the world, so cash and term deposits have been a decent place to hide in the past. However, these days in Australia, with interest rates at zero, there is really no excuse to have a really large portion of your SMSF in cash, with a very few exceptions. What I would say is even a lot of SMSFs in that drawdown retirement stage shouldn't be thinking about having an enormous allocation to cash and term deposits, because your lifespan is still going to be another 20 or 30 years most likely, and that's a long-term horizon. A long-term horizon where you can afford to take a little bit more risk and have other growth assets like shares in your portfolio. So by having a lot of cash, it's really a large drag on your performance, and there's a good chance you're not even going to be able to stay up with inflation. The second big mistake we see still is picking stocks. Now, I think this is really something that has been a problem for many years in Australia. ETFs these days make it much easier to get much better diversification, but still we see so many SMSFs that just have a whole range of stocks in their portfolio. Sometimes there's good reason for this. So if you're sitting on large capital gains, you don't want to be selling positions because of tax. There may be good reasons to have a few direct shares in your portfolio, but outside of some of these edge case tax related reasons, really picking stocks is not something anyone should be doing. Even the professionals can't get it right consistently, so you at home really have no hope in the long run. The reason being that 4 to 6% of companies drive all of the share market performance, and so unless you're in those 4 to 6% of companies, those 4 or 6 out of 100, you're going to be actually underperforming the market. And the chance that you not only have those 4 to 6 in your portfolio today, but are consistently having those top stocks in your portfolio is almost impossible, which is why most fund managers underperform the market, and why it makes total sense to spread your money across the whole market, because it's the only way to guarantee you actually own all of those winners in your portfolio. The third mistake we see is too much focus on dividends. Now, SMSFs have good reason to be focused on dividends because some of the tax benefits of franking credits in Australia. However, there is way too much focus on franking credits, and as a result, portfolios of so many SMSFs are trapped in these stocks like the Aussie banks and Telstra and some of these high dividend paying stocks that ultimately haven't given great returns over the last 10 years because they've been either value traps or they've cut their dividends. And so therefore people have been missing out on the fantastic returns of other growth industries like technology and biotechnology that may not pay high dividends but have astronomical growth. So what we would recommend is to make sure that you're looking at total returns of your portfolio rather than just dividends, because you can always sell down some of the capital part of your portfolio to generate income, and therefore dividends aren't the only place you can actually draw income from. If you actually want to see more detail on this specific area, I've put some links down below where you can see another video I've done just on this topic. And then the final fourth area that we see as a very common mistake for SMSFs is having too much in Australia generally. So often this is because a lot of those direct shares are Australian shares, but Australian shares as an asset class have underperformed global shares and other markets quite significantly over the last 10 years, which means that you're actually missing out on much better returns by only investing in Australian shares. Many years ago, it was tough to get exposure to global shares, so I get it. It wasn't always easy to have access to Apple and Amazon and these great companies in other markets. But these days, with the advent of ETFs and the great ease where you can access all sorts of different ETFs, there's really no excuse to have so much exposure to Australia, and you should be spreading your risk assets into other markets. For our clients, we focus on global developed shares, so the largest 100 companies in the world, as well as emerging markets, which tend to be a little bit more risky, but generally provide higher returns over the long run. Now, if you can avoid all of those mistakes in your SMSF portfolio, you're really going to set yourself up for better long-term returns and more consistent performance, and probably taking less risk as well, because risk isn't just about market risk. Risk is the risk of you not having enough money in retirement, and by missing out on returns, you could actually have a shortfall in retirement, which is a risk in itself. If you like this video or other videos about SMSFs, hit the subscribe button below and you can see other SMSF videos I'm doing regularly.